Ever wondered how some people make money even when the stock market crashes? In the grand stage of global finance, the stock market plays a crucial role. It's a bustling marketplace where companies can raise capital and investors can become part owners of these companies, hoping to share in their success. But the stock market is also a place of great volatility, where fortunes can be made and lost in a matter of minutes. It's a world that's often compared to a roller coaster, full of dizzying highs, terrifying lows, and twists and turns that can leave even the most seasoned investors feeling a little queasy. It's this volatility that often scares people away, leading them to believe that the stock market is a gamble, a game of luck that's only for the brave or the foolish. But here's the thing. Volatility, for all its ups and downs, isn't necessarily a bad thing. In fact, some investors thrive on it. They see it not as a risk but as an opportunity. An opportunity to make money, even when the market is crashing. Sounds counterintuitive, doesn't it? After all, the general idea of investing is to buy low and sell high. But what if the market is plummeting? How do you make money then? Well, believe it or not, there are strategies and financial tools designed to do just that, to profit from a falling market, to turn a crash into a cash-in. And that's what we're going to be exploring in this video. We'll be looking at short selling, a strategy that bets on a stock's price going down. We'll delve into inverse ETFs, financial instruments that rise in value as the market falls. And we'll explore the power of options trading, a versatile tool that can be used to profit in any market condition. So, are you ready to challenge the conventional wisdom? Ready to see the stock market in a whole new light? Stay tuned as we unravel the mystery of making money during a stock market crash. First, we need to understand what a stock market crash is. Picture a bustling marketplace. Now imagine a sudden dramatic drop in most of the prices there. That's essentially a stock market crash. It's a sharp, rapid decline in the prices of securities traded on the stock market, leading to a significant loss of paper wealth. But why does it happen? The stock market is driven by supply and demand. If more people want to buy a stock, its price goes up. If more people want to sell, the price drops. A crash can occur when there's widespread panic selling, often triggered by an unexpected economic event, a catastrophe, or the bursting of a financial bubble. And here's the thing. While a crash might seem like a disaster, it's also an opportunity. When prices are low, it's a prime time to buy stocks at a discount. Now that we understand what a stock market crash is, how can we profit from it? Welcome to the world of short selling. A mysterious realm of the financial markets, short selling is a strategy that can turn a market downturn into a profit opportunity. In its simplest form, short selling is the selling of a security that the seller does not own. It's like borrowing a friend's book, selling it to someone else and then buying it back later to return to your friend. The catch is that you're betting the price of the book will drop, so you can buy it back at a lower price, pocketing the difference. Now imagine this on a grander scale with stocks. You borrow shares from a broker and sell them immediately at their current price. Then you wait for the stock price to fall and buy the shares back at the lower price. You return the shares to your broker, keeping the difference as your profit. But the world of short selling isn't all sunshine and roses. It's a high-risk play. Unlike traditional investments, where your potential loss is limited to the amount you've invested, short selling can lead to infinite losses. If the stock price shoots up instead of falling, you'll have to buy back the shares at a higher price, resulting in a loss. Despite the risks, short selling can be a powerful tool for sophisticated investors, especially during a stock market crash. When markets are falling and most investors are watching their portfolios shrink, short sellers can be making a profit. However, timing is crucial. If you jump into short selling too soon, you could end up buying back the shares at a higher price. If you wait too long, you might miss the opportunity to sell the shares at their peak. Short selling requires a keen understanding of market trends and a strong stomach for risk. It's not for everyone, but for those who master it, the rewards can be substantial. Short selling, though risky, can be a profitable strategy during a market downturn. So if you're up for the challenge and ready to ride the waves of a crashing market, welcome aboard the short selling ship. We're in for quite a journey. Another strategy is investing in inverse ETFs. Now you might be asking, what exactly are inverse ETFs? Well, let's dive into it. Inverse exchange-traded funds, commonly known as inverse ETFs, are a type of exchange-traded fund constructed using various derivatives for the purpose of profiting from a decline in the value of an underlying benchmark. Essentially, they're designed to perform as the inverse of whatever index or benchmark they're tracking. So if the index drops by 2%, The inverse ETF is designed to rise by 2%, and vice versa. As the market goes down, the value of the inverse ETF goes up. It's like a mirror image reflecting the opposite of what the market does. Now, how does this work? Inverse ETFs use a variety of financial instruments such as futures contracts, options, and swaps to achieve their objectives. These instruments allow the fund to borrow shares of stock and sell them on the open market. When the value of these shares decreases, the fund can buy them back at a lower price and pocket the difference. But remember, inverse ETFs are not for the faint-hearted. They are complex financial tools that carry significant risk. They're typically used by sophisticated investors who understand the mechanics of the derivatives markets and are comfortable with the risks involved. While investing in inverse ETFs can be a profitable strategy during a market downturn, it's crucial to understand that these instruments are designed to perform over a single day. Due to the effects of compounding, their performance over longer periods can vary significantly from the inverse performance of their underlying index. So, if you're considering this strategy, make sure to do your homework. Understand the risks, the costs, and the potential rewards. Consult with a financial advisor if you're not sure. Inverse ETFs can provide an opportunity to profit during a market downturn. But like any investment, they should be used judiciously and as part of a diversified portfolio. Always remember, the goal is not just to make money but also to protect what you already have. Options trading can also be a powerful tool during a market crash. Now, options trading may sound complicated, but let's break it down. An option is essentially a contract that gives the holder the right, but not the obligation, to buy or sell a certain asset at a specific price on or before a specific date. There are two types of options: calls and puts. A call option gives the holder the right to buy a stock, while a put option gives the holder the right to sell a stock. Here's where it gets interesting. When the market crashes, the value of stocks goes down, right? But if you have a put option, you can still sell your stock at the higher price specified in your contract. So, while others are watching their investments plummet, you could be making a profit. However, options trading isn't a magic money-making machine. It's a strategy that requires a deep understanding of the market and careful planning. It's like chess, where every move should be calculated and every potential outcome considered. Firstly, options trading is not for the faint-hearted. The risks are high, and the potential for losses is significant. It's crucial to understand that when you're buying an option, you're not buying the underlying asset itself. You're buying the possibility of buying or selling that asset in the future. Secondly, options can be complex. There are many variables to consider, such as the strike price, the expiration date, and the volatility of the underlying asset. It's important to educate yourself and seek the advice of financial professionals before jumping into options trading. Lastly, remember that timing is everything in options trading. Options have an expiration date, and if the market doesn't move in your favor before that date, you could lose your entire investment. Options trading, when done right, can be a lucrative strategy during a market crash. But remember, with great power comes great responsibility. So, arm yourself with knowledge, plan your moves carefully, and always be prepared for every possible outcome. Let's recap what we've learned. We've embarked on a journey to unravel the mystery of making money during a stock market crash. We've recognized that understanding the stock market is our primary step. It's a dynamic world, where fortunes can be made or lost, and where the brave and informed can thrive during downturns. We've delved into the art of short selling, an approach that allows us to profit from downward price movements. It's a bold strategy, but one that requires deep market knowledge and a keen eye for trends. Next, we explored investing in inverse exchange-traded funds, or ETFs. These unique investment vehicles rise in value when their underlying index falls, offering a counterintuitive path to profit. Finally, we examined the power of options trading, a versatile tool that can generate income or hedge against losses. Thanks for watching. If you enjoyed this video, subscribe to our channel for more insightful content.